Hey guys, thanks for joining me for another video. I'm going to do some analysis on the broad market and specifically triple Qs, which is the 100 largest NASDAQ technology-based stocks. And I'm going to give you my logic for my bearish trades and why and how I'm putting them on. First, I'll start off with the big picture. Big picture is the PE ratio, the Shiller PE ratio or the regular PE ratio. And if you look, stocks are expensive according to the Shiller PE ratio. They are 38.6 price to earnings right now. So there's a high price you're paying for 38 years of earnings. Now, on the low side, if stocks were cheap, they would be in the lower range, somewhere between 5 and 10 and 10 to 15. So half as much, or stocks are at least twice as expensive as what would be considered cheap. Everybody knows this. Stocks are up. They're in a major, people are calling it a bubble, but it's a major uptrend. The way I want to express it is I want to look for an opportunity to sell the highs in the market. If we look back on let's look at the monthly. Let me take off that trend. And if you look, stocks since the health crisis have exploded up. So it's more probable that stocks are expensive than stocks are cheap. That was the monthly chart. If we look at the weekly chart, same thing. We had the health crisis, and then we've had this explosive run-up on the tech stocks. So it's more likely that stocks are above average and not cheap. And then if we look at the daily, it's been in an uptrend. Let me put that channel back on. So stocks have recently been moving in this upward channel. And if I were a buyer, the bottom of this channel is where I would want to buy. And what we notice is it's at the bottom of the channel, and then it rises, bottom of the channel, and then rises, bottom of the channel, and then rises. And then also, when the prices are at the lower end of that channel, the RSI, the relative strength indicator, is also at or below 50. At or below 50. And we are not there now. So in order for the Qs to be cheap, we would want to see something in the 340 level and an RSI reading of around 40. So because I don't think this is a good entry, it doesn't mean that stocks can't go up, because when we're making new highs, it's a very dangerous time to put on a bearish position. And I could be wrong, but in my opinion, I think this is a good entry. The other thing to look at is the periods when the market is making higher highs and what the indicator does. If you look at the indicator, when the highs are rising but they're losing momentum, you're going to see a divergence. So we have higher prices, but we have a declining or less strong RSI. Same thing with this period right here, from April to May. There was a flat price action before a dip, but the RSI also preceded with weakness. So that would be a divergence. And then we currently have one right now. So we have RSI going from 76 to 58, while prices have been rising. So given this information, the strategies that I'm going to use are selling call spreads above the market and looking to buy in the money put spreads. Puts or put spreads. I have a combination of all three. So at this current level, one way to put it on would be like a 380, 370 spread and try to get as much money, usually around 50%. So if I was selling the call spread, I would be selling that 370 strike right around there, and then buying the 380. And that would create a $10 spread, and I might collect $5 or $6 on it. And I would try to put it out three months or so. 2 to 3 months works pretty well, just in case it spikes up and then dips. And that's just my opinion. I cannot recommend anything for anyone. You got to do your own homework. And then the other way to put this trade on would be like a 380 put. Those seem to work the best in my opinion. You buy, or I buy something above the market, a put, and I'm hoping that the market dips somewhere into that level. Now, I don't know what happens after that, but I would be taking at least partial profits at that point and reassessing the situation with the market. Hoping that the market crashes has not been working. So until something changes, that change would have to be like a breakdown of a previous low. I have to assume that the market's going to continue in this channel. So the trade design and trade structure would just be to take the space between 367 and around 340, probably previous support. That would be the width of the trade. So what is that in percent terms? We're looking for about 7% potential move in the market. So I'll just leave it like that. Quickly, I'll go over to the S&P 500. Similar situation. Not as weak yet, though. So if you look at the S&P, there is a double divergence. There's divergence here. We've got flat RSI as well. If you look at just that move, it is not confirming the upside. So the trade would be the same. Probably in the next few days, I would want to see the S&P start to roll over for the trade to put on in the S&P. That's why I like the NASDAQ more. Let me look at the NDX instead. If we look at the NDX, we've got the declining RSI, and we have red bars. We have to see that selling. If you don't see the selling, it doesn't make any sense to start going short. Let me look at cubes to see some volume. Yeah, we have some red volume on red days, of course. We want to see the volume increase as the selling increases. So that's my explanation of my view. I think that this would be a good entry to explore and look for downside in the Qs. And then in the next couple of weeks, I would look to see if that spreads to the SPY. Remember, the biggest names like Apple, Facebook, Google, Microsoft, they're all over. They're in the S&P, they're in the NASDAQ, they're even in the Dow. So the price action will be similar across the indexes. Here's Apple. We see those red days. We see the red volume. So do your homework, and if you agree or disagree, let me know.